Aloha. I've been asked by the Hawaii CCIM chapter, which stands for Certified Commercial Investment Members, to do an updated report on retail investment trends. I'll be sitting on a panel with Roger Wall from Foodland Supermarkets and Todd Hedrick from McNaughton Group. But I thought I would put my presentation down and share it with you at this juncture. I'm going to talk about a couple different things, trends across the mainland in retail investment properties, Colliers results and insights that we're seeing within retail investment properties, and then things we're seeing that are going on in Hawaii, and then particular local investor sentiment through a recent poll that we did. So starting with mainland trends, looking at Real Capital Analytics, or RCA, which a lot of us use. Values are down for the year 2020 about just 4.3%, so maybe a little less than you would have thought. Grocery and drugstore anchored properties are up 3.6%, and we can all imagine why after coming out of this pandemic. Cap rates. Average cap rates fell a little bit to about 6.5% nationwide for retail properties across the board. So those are all different types of retail properties, again, across the U.S. They were rising a little bit between 2016 and 2019. And so the sales that did happen last year, the cap rates ticked out a little bit, mainly because of lack of supply and inventory on the market. Shopping center cap rates fell 10 basis points, and the demand for pad sites, grocery stores was up, as you can imagine. Distress, so there's $23.3 billion in distressed loans being tracked, and most of you know distressed loans is quite a big range. So something is out of whack on a measurement, or the vacancy is big, or they're not meeting debt service coverage ratio, or one of their covenants has been broken. So again, a large array of different situations. Not all will go bad. One interesting thing I saw was that distressed sales have been the same percentage of the total retail investment sales across the country as the period from 2015 through 2019. So there still hasn't been a lot of retail distressed sales in the marketplace. As we know, the lenders are working with most borrowers. There does exist an opportunity for recapitalizations, the sale of loans, and some creative conversions in the marketplace. One thing to watch out for that we're seeing is the reappraisals of some retail properties, particularly malls and unanchored properties. So that could trigger some covenants or some issues for owners going forward. Portfolios are starting to come back. So we just saw the first portfolio sale. Private buyers led the way through the pandemic with institutions virtually shut down. One of the biggest sales of the year was the Simon Taubman merger, and that included one property here in Hawaii at the international marketplace. So switching to our company, Colliers, across the United States, our retail sales volume was off 43% compared to 2020 to 2019. And I think a lot of that is that the retail category has, I'm going to say temporarily, fallen out of favor. So people saw a lot more risk in the middle of the pandemic, and so they just kept their properties off the market and weren't sellers at that point. And the buyers were looking for exceptional deals, priced for what the perceived risk might be. 2020, we did $1.25 billion in retail investment sales. And then most importantly, our Q1 2021 over Q1 2020, retail investment sales for our company is up 29%. So things have stabilized a bit. A few properties available for sale at this point in time. So switching to Hawaii. So we were asked to look at investment transactions going back to January of 2020, and this will be through April and into early May of 2021. So during that period, we tracked 56 retail transactions. The biggest thing you can see is they're mostly small. So 44 of those transactions are below $5 million. 12 are over $5 million. And the low point for volume was in May 2020 with only one transaction. And we can imagine why when everything was shut down. We were asked also to compare 2019 investment property sales to what's happened in 2021 so far. So first quarter, retail investment property sales are off 60%. So again, I believe it's that lack of inventory and retail falling out of favor with investors. There were 4 large transactions since 2020. And let's take a look at what's driving those sales. So in January of 2020, the King Kalakaua Plaza sold for $75 million, as we reported on. That was close to being entitled for a Marriott timeshare project, and so that was definitely a pre-pandemic sale. The International Marketplace closed, as the previously mentioned, Simon Taubman merger. They marked it at about $110 million. That is below what was reported as construction cost for the project. So it may have been a point in time to write down some valuations as reported by CoStar. Par Pacific did a sale leaseback of a group of gas stations. It was a $116,100,000 transaction. It happened in February of this year. They were losing money throughout last year with the refinery close and a lot less demand. Those sale leasebacks included a 15-year term with 20 years worth of options. It'll be interesting to see kind of what the cap rates worked out to be. Servco did a sale leaseback of their auto dealership in March of this year for $24,750,000. That was planned pre-pandemic. They have been on the road to downsizing their physical retail assets and real estate assets as the car market changes. Interesting enough, is a local buyer on that. And then reported just recently, the Waikiki Galleria DFS building is in escrow. It does have a large retail vacancy, which will work for repositioning, and then many floors of office space above in a A-plus location on Kalakaua Avenue. Trends we are seeing locally. So local investor sentiment. Unanchored retail cap rates in the poll we did, most investors said are up about 50 basis points. And the other thing that was pointed out to us is they said, well, a cap rate isn't as interesting or as important, I should say, as it was before the pandemic. Now what we want to know is, what does the net operating income for that property actually look like in 12, 24, 36 months? So it's really breaking it down tenant by tenant and assessing what you believe the performance will be. So there is a little bit of distress in the market, as you can imagine. So in special servicing right now is the Queen Kahumanu Mall and King Shops. Those are both in receivership. So those are a lot of resort retail there that are going to need to be repositioned going into the future. The Hawaii Kai Shopping Center, the Poipu Shops, Kona Coast Shopping Center, and Whalers Village round out the list of properties, retail properties on the special servicing market. The next category down is the watch list. So there's 4 other properties. They're all resort properties, as you can imagine. And then Pearl Ridge Mall owners are renegotiating their debt at Washington Prime Group. And we talked a little bit about it here, but it's important when you're looking at Hawaii retail investments to have a distinction between retail for local residents and retail for visitors in resorts. We are seeing some conversion of retail to medical use. I think that was starting pre-pandemic, but it's a solid use, brings traffic to the centers and increases value. So I mentioned earlier there's been a lack of inventory. So as we sit here today in May of 2021, there are 18 properties on the market over $20 million for sale, 26 properties between 10 and 12 million. And a lot of those are certainly not investment grade or provide much of a current return. So there are not a lot of choices for investors at this time. I expect to see that go up a bit as the market levels out, but I think that still could be, another 12 months away. So when you think about it, or investors are asking us about alternative investments, to real estate. Stock market's been great, but a flight to safety probably only gets you a 2% annual return and with no tax shelter. So if you're up for stomaching the stock markets and maybe Bitcoin today, then you maybe be able to get a higher return. So one of the things we've seen here lately is we have 3 listings that are all either net leases, ground leases, or pad leases. And so that flight to quality, we did start marketing these last year in the middle of the pandemic, and we were not able to get those into escrow. One of them we did pull off the market, but all 3 are in escrow now, and cap rates have come down, or you could say pricing has come up to our expectations pre-pandemic. So that flight to safety. And the other thing that's happening here is, I would say once a week we get an inquiry from private investors who are very well heeled. They own large portfolios other places, and they either want to spend more time here, they may want to move here, and they are often looking to get their kids into school here. So we're seeing demand. I think it takes those types of investors a couple of years to get comfortable. They usually say, let's put our little toe in first, but I think several will become large retail investors over time. Thanks so much for spending this time with me for this longer video. As always, you can find our listings at thebrattonteam.com.